We get asked all the time if there's strategies to reduce your tax bill, and there's quite a few that we'll implement for clients, and today I want to go through one of them that could save you tens of thousands of dollars over the next few years. The strategy I'm talking about today is a spousal RRSP as an income source for a low income or no income spouse for down the road. In this short video, I'm going to go through when, what, why, and how to implement this strategy to save you potentially tens of thousands of dollars over the next 3, 4, 5 years. So when does this strategy make sense? It makes sense when you have a high income earner and a low to zero income earner in your household. So this could be one spouse working and another spouse, at home raising kids, whatever it is. It can also work if there's one spouse that may be working and earning income, but in 3 to 5 years is expected to have no to little income. So maybe you're just starting your family planning and you know that one of the spouses is going to be staying at home with the kids in 3 to 5 years moving forward. This strategy works for that as well. So what is the strategy? Well, the strategy is when the high income earner puts money into a spousal RRSP. The high income earner receives the tax deduction, they are the contributor, but the account is held under the spouse. With spousal RRSPs, there's a 3-year income attribution rule, which means that if the spouse takes out the money in the first 3 years, the income goes back to the original contributor. So if we put money into a spousal RRSP in 2021, we don't want to put anything in or touch that account for 2021, 22, and 23. But in 2024, we're able to redeem money out of the spousal RRSP and it's taxed in the lower income spouse's hands, which could potentially be zero tax liability. So why is this a great strategy and why is this a way to reduce or eliminate taxes on income down the road? Well, let me tell you. The contributor or the high income earner receives a tax deduction now. Okay, so it's an immediate tax deduction for the contribution. The spouse or low income earner in the family can then redeem that money down the road, potentially tax-free. And I'll go through an example here in a minute that shows how that works. This strategy essentially allows you to make an RRSP contribution, get a tax break, a tax deduction today, allow that money to grow tax deferred within the RRSP, and potentially take it all out tax-free in 3 years. So essentially, it's a way to turn $20,000 into about $25,000 today, let it grow tax deferred, and pull out close to $30,000 down the road tax-free. Let me explain. Let's take the example of Jane and Tom. Jane works full-time, earning $100,000 a year. Tom stays at home with the kids. They have some money put aside for an RRSP contribution this year, and they have $25,000 that they want to contribute to an RRSP. Jane has lots of contribution room, so that isn't a consideration in this example. The typical process would be Jane would contribute $25,000 to her own RRSP, let it grow tax deferred to retirement, and in retirement she would start taking money out of her RRSP and it would be taxable income to her. If it was in a RIF, it could be split income. But let's look at using that $25,000 in a spousal RRSP. So Jane decides to put the $25,000 into her spousal RRSP under Tom's name. She's a contributor, she still gets the tax deduction for this calendar year. She can also carry forward those deductions for future years if it makes more sense. So Jane has now made a $25,000 contribution to a spousal RRSP. That $25,000 contribution is going to give her $7,700 tax refund back. So she's turned her $25,000 into $32,000+. With this strategy, I want to focus on the spousal RRSP. So now that the $25,000 is in an RRSP and invested, let's assume it grows at 5% for the next few years. So we put money in 2021. We don't put anything in 2022 or 2023. That means that Tom can take money out of the spousal RRSP in 2024, and anything that he takes out will be taxed in his hands and not in Jane's hands. This is very important. If you wait the 3 years, which is the attribution rule on a spousal RRSP, then the income will be taxed in the redemption of the hands, not the contributor. So let's fast forward to 2024, and Tom decides that they're going to take the money out of the RRSP in 2 separate withdrawals over 2 years. So the $25,000 has grown to almost $29,000 at 5%. Tom and Jane talk and they decide to take $15,000 out of the spousal RRSP. That $15,000 is income to Tom. Since Tom has no other income, because he's at home raising the kids, it's tax-free income to him. The following year, they decide to take out the remainder of the money, which is just shy of $15,000. Again, tax-free. So now they've been able to take out almost $30,000 out of the spousal RRSP over 2 years, tax-free. So they got a $7,700 tax break when they put the money in originally, and they've taken all that money out tax-free. This plan works really, really well. It's very simple to run. And again, when you take that money out down the road, it's tax-free money. And there's not a lot of ways to earn tax-free money nowadays. The government will get their taxes. But this is one strategy that you can use, you can implement. If you have a large amount of money to put in an RRSP, and by large amount, it's usually about $10,000 or more into an RRSP, look to use a spousal RRSP if you have a low to no income earner in your household. And to compound the benefits even further, if you took that $7,700 tax deduction in year 1, plus you took out your contributions that were tax-free in years 3 and 4, you could essentially invest those again back into an RRSP or a TFSA and compound that money long-term on a tax-free basis. So there you have it. There's a way to earn $7,700 and more tax-free within a few years. So you could turn $25,000 into over $30,000, $35,000 on a tax-free basis and keep compounding this money tax-free going forward. So it's a very simple strategy, but a lot of people overlook it in their financial plan. So if you fall into the situation where you have a high income earner and a low income earner in your household and you're looking to make a larger RRSP deposit, consider a spousal RRSP and plan to use it as a redemption tool down the road in 3 to 4 years, which you can then recontribute to an RRSP for further tax breaks and to further build your wealth and help your financial plan towards retirement. Thanks so much for joining us today. I hope this was helpful. If you implement these plans, they will put a lot of money back in your pocket. Of course, if you like the videos, make sure to hit a like. And if you haven't subscribed to the channel, make sure to do so. We release a new video every Tuesday and Friday. Thanks so much for joining us. Have a great week.